Yeah, because it is. Chapter 3 is a little bit different. We're still doing journal entries, but we're getting into adjusting process. So basically, through this point, we of course have learned to journalize and post, and then do that unadjusted trial balance. And we've learned the basic statements. We just haven't hit those the full time yet. So with chapter 3, what we get to is we're at the end of the period, whether it's the month or the year, and we need to make sure that all of our accounts are up to date. So the whole purpose of these adjusting entries is basically to make sure that we've recognized all the revenue that we've actually earned and all the expenses that have actually been incurred. So all of our adjusting entries actually revolve around either revenue or expenses. So that's a good thing. You'll know at least half of it is going to be either revenue or expenses. So the whole purpose of them, just to kind of give you a little bit of background, you know, we talked about in chapter 1, like the principles of accounting with generally accepted accounting principles. And we have that revenue recognition principle that states, you know, revenue is recognized the period in which it was actually earned. So if there's any revenue that we haven't yet recognized, but it's been earned in the current period, at the end of the year, we need to recognize that. And really what we mean there is a lot of times it may be that we've completed a job and we just haven't billed for it yet. So we need to go ahead and bill for it in the period in which it was completed. So that's one big one. And another one, which we'll get into in financial, we won't do in college accounting, is like interest. So if there's any interest that we've earned on like other accounts of interest revenue, we would recognize that at the end of the period. So this is revenue that we're not getting in cash right now, but we'll get maybe next year, but we earned it in this period. So any revenue that's been earned in this period and hasn't been recognized needs to do so. So we have accrued revenue, which is like that, just revenue that we've earned and we haven't billed for or we haven't recognized. And then we have deferred revenue, which is that unearned revenue. So we talked about that in chapter 2, where like ticket sales or magazine sales, that they may pay us up front and then we owe them the service later. So now if we've provided the magazine or we've provided the tickets, then that becomes earned revenue. So it's just taking any portion of unearned revenue and switching it to earned revenue. So those are the revenue adjustments that we do. Those are just 2 entries, 2 adjusting entry types. So we're going to break those down and look at them. And then on the expense side, we also can have accrued expenses. So that's something that we've already incurred the expense, but we just haven't recognized it either.
Yeah, I don't get the whole payroll. Like,
yeah, so what happens is, you know, a lot of times we know employees work and they accrue pay and then we pay them like a week later, right? Or 3 days later. You know, you may work Monday through Friday and then get paid the next Friday. That's how my husband's job is. He gets paid for last week, you know, the following Friday. Whatever our pay, if we were like a weekly payroll. So that's a common occurrence. So what happens is, say we're at the end of the year and it falls that week, maybe like it's December 30th and 31st is on Monday, Tuesday, and then you have January 1st, 2nd, 3rd. So you have a week of payroll that's actually covering 2 separate years.
Okay, that makes way more sense. Because like I was looking at it completely different. Like okay, we went ahead and I wasn't thinking of it correctly.
Yeah, so that's all it is. It's that basically they've earned wages and we're not paying them yet. So, but we need to recognize any wages that were earned in the current year. So usually that happens, that a payroll falls in the middle where it's part of the payroll's, you know, 2018 and part of it's 2019.
Okay.
Which is a pretty common occurrence. I mean, unfortunately, we can't get payroll. Yeah. If you get paid monthly, you know, it might work out that way, where we could at least, you know, like here at the college, for like we get paid monthly, and so our December paycheck, they actually cut the last working day of the school year, so we get paid early. It's usually it's always the last working day of the month, which is usually like the 30th or 31st. But since the school closes like December 22nd or something, we get that paid early. So they go ahead and run it and expense it off. It's no big deal.
Okay.
But a lot of companies can't do that.
And that's good to know, by the way.
Yeah, yeah.
So that I'm a work study.
Right? Yeah, you'll get paid. You get paid a little differently because they're not going to be here for 2 weeks either. Right. So they have to do payroll at different times. But most jobs, it does work where, you know, especially with hourly employees, well, they have to submit a timesheet. And so then you're waiting and submitting at a later date. So that's all the accrued wages is. So that's an accrued
Okay.
expense. So it's just saying, so these employees have actually earned salary. We're not paying them till maybe January 5th or something when payroll falls, but we need to recognize the expense of any days they've worked in this year. So that's all that one is. So that one's not too bad. And we're going to break these down in a minute too on the board even. And then the other expenses that we have to recognize are deferred expenses. And we've already done one. We did it with supplies. If you remember, you know, when we first purchased supplies, they were an asset. And then as they get used up, we expense them out. That's the same with any deferred expense. So we're going to do the same with like prepaid rent or prepaid insurance. So prepaid rent, prepaid insurance, and supplies, we all consider kind of like prepaid expenses. So when we purchase them, we log them as an asset. And then as at the end of the period, we see what did we actually use, and we expense out what we used. It's not too bad. And then the only new one that we deal with is depreciation. So depreciation is just like the decline in value of assets. So we're looking at, in this case, and we'll look at examples too, but just to give you an overview. A fixed asset, I'm gonna close this because it's distracting me, is like land, buildings, vehicles, equipment, things like that. So fixed assets are things we're going to use for more than 1 year in the business. So what we're doing with depreciation is we're basically saying, okay, so we bought this building and we're going to be in it like this building 20 years or 80 years or however long we're going to be here. And we're just going to spread the cost of that building over the time that we use it. So that's the whole point of depreciation. In this class, you won't actually have to calculate depreciation. They're going to give you the depreciation amount, which they didn't used to, so that's that's kind of nice. In financial, you'll learn actually how to calculate depreciation. But in college accounting, we're just going to learn how to account for it. So basically, land never depreciates. It actually usually appreciates in value. But everything else, it's just like if you drive a vehicle yourself, we know as soon as you drive it off the lot, the value goes down. So that's depreciation. So basically, if I think, oh, I'm going to use this vehicle for 10 years, I'm taking the cost that I paid and just spreading that cost over 10 years. And the reason we do that is we're using that vehicle to earn profit for 10 years. So the expense needs to match the revenue, okay? So if it's helping us earn profits in year 2, we need to show the expense incurred of using that vehicle in year 2. So instead of just costing it all out in year 1, we spread it out over what we call the useful life. Does that make sense? So it's basically just, yeah, saying if I'm going to use it for 5 years, then I need to cost it out over 5 years because it's helping me earn revenue all 5 years. So again, we'll learn more in financial accounting about how to calculate that. But really what you need to know in this class is what depreciation is and then how to recognize the expense. And we'll go over that in a little bit. And then I think the only other thing, we'll talk about the book value. So the book value is just like the current value. So you would take your costs that you paid minus any depreciation. And that just tells you kind of the current book value, which is what's reported on the balance sheet. So you're going to see like vehicle and the cost we paid minus any depreciation. And so it kind of shows you the actual value. It's kind of similar to like what you still owe on your car payment or something, or the value of that car. Like if you went on Kelley Blue Book, you know, and looked at the value of the car, that's like a book value. It's how much you could possibly sell it for, you know, if you had to replace it. So that's important in accounting. The book value comes into play when we do like sell it or get rid of it, which again, we don't deal with in this class. So you just need to know how to recognize depreciation and then understand the book value, okay? So, so just before we get started on that, basically, the 4 main types of adjusting entries, which we've already kind of talked about. We already did talk about. Better marker here. Yeah, there we go. You have accrual type ones. And for accruals, we have both revenue and expenses. So accrued revenues, again, is when you've earned income and you just haven't billed for it yet. So when we recognize that, this is always done, adjusting entries are always done at the end of the period, so the last working day in the period. A lot of times that'd be like December 31st. We're always just going to debit accounts receivable. And then we're going to credit fees earned or whatever our revenue account is. Okay. So anytime you have accrued revenue, that's going to be your basic journal entry. Is going to be to debit accounts receivable and credit revenue, which is just anytime you bill clients. So it's really not a new entry. It's just we're talking about it in a different way. And then with accrued expenses, this is like your salary that we were talking about. Expenses that have been incurred that we just haven't recognized yet. We're always going to debit. In this class, it'll only really be wages or salary expense. Wages expense. And we're going to credit wages payable. Okay, so with an accrued expense, which is an expense that we haven't yet recognized. So we would debit, for example, the one that we do, wages expense and credit wages payable. So we're paying them these wages. Maybe it's next week or maybe it's tomorrow, but it's in the next year. Okay, so we create a liability to show we owe that. Okay, so those are your accruals. Those are the two types of adjusting entries that are accruals. On the flip side of that, you have deferrals. So deferred revenue is just your unearned revenue. So again, when we have deferred revenue, we've already been paid up front. And we, if you remember when we sold tickets for a concert or something, we debited cash and we credited the liability unearned ticket sales or ticket revenues. So now at the end of the year, we just need to look at, well, how many concerts actually have been completed and what portion of that revenue is now earned. So we're really just taking unearned revenue and converting it into earned. So you're going to debit unearned revenue and credit the actual revenue account for whatever portion has been earned. And then deferred expenses are those prepaid expenses. So again, these are supplies, prepaid insurance, and prepaid rent. So in this case, again, you're just recognizing how many supplies have been used up, or how much rent, or how much insurance. So you debit an expense account, like rent expense, supplies expense, and you credit the asset. Okay, so whether that's supplies, or prepaid rent, or prepaid insurance. And again, we've done that one with supplies, but now we're just expanding it into prepaid rent and insurance as well. So it's not really a new concept. And then our new one, of course, is that depreciation, which kind of falls under this. So prepaid is kind of the first one. And then you have depreciation. Well, whenever they tell you, our vehicle does depreciated this amount, you're going to debit depreciation expense. And then you're going to credit this new account called accumulated depreciation. And then whatever, vehicle, it'll be like on the vehicle or on the office equipment or the building or whatever it is. So for depreciation, we debit depreciation expense and we credit this new account called accumulated depreciation. So accumulated depreciation is a new type of account, okay? Because what happens is it's really just a placeholder for the decline in value. So you're still going to have your asset that you've purchased, like a vehicle. If you purchase a vehicle, you're going to list it in your books as an asset, debit, whatever the cost was. So that vehicle is going to stay in your books at cost until we get rid of it. So we create accumulated depreciation as the placeholder to keep that decline in value. So accumulated depreciation is what we call a contra asset account. Contra just means opposite. So it increases on the credit side. Okay. So accumulated depreciation is a contra asset account, so it increases on the credit side. So again, when we look at what I was talking about, like the book value of something, and that's how it'll show on our balance sheet, we're going to have the cost minus that accumulated depreciation. So for instance, if we had a vehicle that we paid $10,000 and it had accumulated depreciation at $2,000, its book value would be $8,000. So the cost of the vehicle is going to be debited to the asset account vehicle. And then every time we recognize depreciation, it'll be credited to accumulated depreciation. So are there any questions on that before we do some examples of these? Okay. I'm just going to start looking at some examples here. So I have a few to go through. Forgot to bring my cheat sheet, so I'll just have to, oh no, I have them here. Never mind, that's another class. Yeah, I'm getting confused. I teach a 16-week like traditional too, and so we do a little bit different. Like, which ones did I bring? I brought the right ones, so that's good. So this first one, we're dealing with accrued revenues. And so it tells us that, so we know, bless you, that we're going to debit accounts receivable and credit revenue. So see, like if you can identify which of the 4 types of entries it is, then you kind of have this little game plan here. So it's not too bad. And as you can see, when we're dealing with revenue, whether it's an accrual or a deferral, you're always crediting a revenue account. So if you know it's dealing with revenue, you're going to credit revenue if it's an adjusting entry. And then on the flip side of that with expenses, it doesn't matter what type, if it's an accrual or a deferred expense, you're always debiting an expense account. It's a good dark. That's kind of nice, not full lighting, right? So in this case, all it's saying is we have accrued revenues. At the end of the current year, we have $17,555 of fees that have been earned, but we haven't billed to the client yet. Okay, so really that's the same entry you would do anytime you bill a client. So it's an accrued revenue. So we're truly just going to debit accounts receivable and credit fees earned. And in this case, it's the full amount they gave us, the $17,555. So anytime you see fees earned but not yet billed, that is an accrued revenue. And you're just going to bill the clients. So it's not too bad. Okay. We're going to break them down one by one and then do a big one. So we can move on to the next one. So this one is an accrued expense. It says Prospect Realty Company pays weekly salaries of $27,600 on Monday for a 6-day work week ending the preceding Saturday. So they work Monday through Saturday, and then they get paid the following Monday. This one says journalize the necessary adjusting entry at the end of the accounting period, assuming the period ends on Friday. So this one we actually have to do a little bit of math. It's a little tricky. So that's where adjusting entries get a little tricky because we know it's an accrued expense. So we're going to debit salaries or wages expense and credit, salaries payable. So that part we know because we can follow the little guidelines there. But it's telling us basically what's happening is the accounting period is ending on Friday instead of Saturday. So again, those are wages, 5 days worth of wages that have accrued that we're going to put into a payable account. So in this one, we do have to figure out, instead of 6 days, you have to figure out what 5 days are, you know. So 27,600 divided by 6 days is, well, I don't know, I didn't put that down. And then we would multiply it by 5, you know, to get 5 days worth. So 27,600 divided by 6 days, and then times 5, 23, how much?
23.
Yeah, 23,000. So 23,000 has, you know, accrued that we owe. Okay. So on this one, we're truly just debiting salaries expense and crediting salaries payable for 23,000. So again, on these, it's just important that we look at the amounts, and that's on all of them, really. You know, we read the wording and make sure, okay, we're only doing 5 days, because that's where I see the most mistakes, honestly, on adjusting entries are the amounts. You know, we get tripped up a little bit, and we want to do the whole 27,600. Okay. So on that Monday, when they get paid, they're going to get paid the full 27,600. We've just already recognized 5 days worth as an expense. So when we run payroll on the next accounting period, we're going to recognize 1 day of salary expense, pay them the full 27,600. Okay. So their pay isn't affected by this. It's just our accounting practices that are affected. Okay. Any questions on that one? Alrighty. The next one. Okay, so here we're looking at unearned revenue, which is a deferred revenue. So it says on June 1st of 2018, Herbold Company received $18,900 for the rent of land for 12 months. So someone paid us $18,900 to rent land from us, okay, for 12 months. So now we're at the end of the year, and we need to journalize the adjusting entry for unearned rent as of December 31st. So again, on June 1st, when they paid us that, we debited cash, $18,900, and we credited unearned rent to that liability. Well, now, you know, several months have passed, 7 months, right? June through December has now passed. So 7 months of that rent is now earned rent, okay, rent revenue. So all we're doing here is, again, we're going to calculate 7 months worth and adjust that. So we're going to debit unearned revenue and credit revenue. So when we're done with this adjusting entry, unearned rent will be 5 months worth that we still owe them, you know, of rental services. Okay. So again, we're just going to follow the same little thing here, that unearned rent would be debited and rent revenue would be credited. And we would just calculate 7 months of the rent. So how much is 7 months of this $18,900?
You said 8.
7 months. 7 months.
11,027. 11,000.
25?
25.
Yeah, okay,
sorry.
perfect. Yeah, you're good. So $11,025 is now earned. So again, we have to calculate how many months. So June through December was 7 months. So 7 months of that 12 months, you know, unearned rent has now been earned. Okay. Any questions on that one? Again, a lot of this is just calculating the amounts. When they tell you what type of adjustment it is, it's easier there, right? I don't have to categorize it. So now we're looking at prepaid. Prepaid insurance account had a beginning balance of $4,500 and was debited for $16,600 of premiums paid during the year. Okay, so all total, you know, we had what, like $21,100 of premiums So that's all total what we had through the year. So we have to kind of balance that prepaid insurance account before we even get started. Okay. So we had a beginning balance of $4,500. We purchased another $16,600. So all total, we had like $21,100 of prepaid insurance. And then at the end of the year, we're going to assume that the unexpired amount is $5,600. So again, these just get a little tricky with their wording. So what we're basically looking at here is we have prepaid insurance. And it's an asset. So we'd originally started with $4,500, and then we had another $16,600. Okay. So again, all total, we had what, $21,100. Well, we unexpired, we have $5,600 left. So basically what they're saying is our balance at the end of the year is $5,600. Okay. I know that's kind of hard to see. I need another board, like a third board. Okay. So all total, we had $21,100, and we still have $5,600 left. So to me, it helps to write out the T account to kind of see what they're asking. So how much was used? How would I calculate? Or what was?
You would subtract it.
Right.
So it'd be 20,540.
Wait, that's too much. The your 21,100 minus your 5,600. Did you take 560 off maybe?
I did.
I'm like, that sounds right.
$15,500.
That sounds good. So 15,500, I'm going to put an ADJ for adjusting, was actually used or credited out. Okay, that's what we need to show. We need to show that we used up 15,500 of insurance. So since we used it up, we need to expense it out. So that's why we debit insurance expense, and then we credit the prepaid insurance, like what I showed here, for that 15,500. So again, it's just really reading the question, because sometimes they'll just tell you what was used. So you have to figure out, are they telling me what's left, or are they telling me what we used? Because if they tell you, oh, we used up 5,000, well, that's your adjusting entry amount. But if they tell you what's left, that's your ending balance. So you'll have to subtract to get your adjusting entry. That's where they get kind of tricky. And that would be the same if it were rent. This one's insurance, but if it were rent or supplies, the prepaid expenses work the same way. Let's see. Depreciation. Well, again, this one's pretty easy. They tell us the estimated amount of depreciation on equipment for the current year is $7,700. So I truly am just going to debit depreciation expense and credit accumulated depreciation on the equipment for the $7,700. So debit depreciation expense, credit accumulated depreciation on equipment for $7,700. So at this point, our depreciation entry is pretty easy peasy. Again, we'll expand on that. If you take financial accounting, you'll learn a lot more about depreciation. But right now, it's just good to understand it is an adjusting entry that we do at the end of the year on all of our fixed assets, besides land. And I can next. The last little example we're going to do, and then we're going to look at a bigger one, is supplies. Again, supplies still falls under that prepaid expense. So it works just like we did insurance. So it tells us the balance in the supplies account before adjustment was $4,850. And now we have $880 left. So how many supplies did we use and we need to expense out? So we had $4,850 and now we have $880 left. So if we had 4850 and we have 880 left, how many did we use?
3970.
Very good, 3970. So again, we'll debit, in this case, supplies expense and credit the asset supplies. So what that does is now my supplies ending balance is 880. So it matches what we have on hand. Okay, so those are the little examples to kind of get us started on adjusting entries. Now we'll start the fun one that gives us a lot more information here. The big one. So this is Reese Financial Services, specializes in appliance repair services. We have the following unadjusted trial balance, which is important to us. So here's all the balances of all of our accounts before we did any adjustments. So we've journalized and posted for this month or whatnot, or is it the year? Yeah, for the year. And now we're at the end of the year. So there's all of our balances. And it tells us we need to do year-end adjustments for these following situations. So again, they're going to fall under one of these 4 categories. And we're going to journalize the adjusting entries, and they tell us what accounts to use. And we're going to have to look at this unadjusted trial balance to figure out some of the amounts. So.
I printed out a lot of stuff for your class.
I
makes it
do
easier.
too, right? Yeah. It's not much easier than flipping back and forth. So sorry. I did the same. No, see, yeah. I have it printed too. So the first one, we're starting with depreciation of the building for the year. So they just want us to journalize the adjusting entry for depreciation. Well, again, we're just going to follow this little formula or blueprint for depreciation, and they give us the amount. So that one's pretty easy. That one, where you're just going to debit depreciation expense on the building and credit accumulated depreciation on the building for the 6,400. Okay. So again, depreciation entries will always be debit depreciation expense and credit accumulated depreciation, and just whatever amount they give you. So both of those are pretty straightforward. So the second one, when it says depreciation equipment for 2,800, the second entry is the same as the first, just, you know, we're looking at equipment here instead. So we'll have depreciation expense on the equipment. What was it, 2,800? And accumulated depreciation, I want to add an extra number in there, for 2,800. It's like it just wanted to be there. Okay. So those are the depreciation ones. The next one said we had accrued salaries and wages as of July 31st of $900. Well, accrued salaries, that's an accrued expense. So what would I debit and credit to recognize that accrued salaries and wages? And it's what, $900? What would I debit?
Wage expense.
Yeah, we're just going to debit. Very good. In this case, it's called salaries and wages expense, and it was $900. And then what do I need to credit?
Wage payable.
Yeah, salaries and wages payable. Very good. So salaries and wages payable get credited $900. So again, that's an accrued expense. So we always debit an expense and credit a payable because we owe them that at a later date. Let's see, our next one. We have unexpired insurance as of July 31st is $1,500. Well, here's where we have to look at our current balance, you know, and see what expired. First of all, this falls under a prepaid expense. So we know we're going to follow that format. But insurance, if I look at my prepaid insurance account, it's $6,000. Okay, so we started with 6,000. That's the unadjusted amount. And it should be an ending balance of 1,500. So how much insurance did we use up in the current year? $4,500. Very good, 4,500. And since that's a prepaid expense, you know, we've actually used up that amount of insurance, so we need to expense it out. So insurance expense is debited, and prepaid insurance is credited for 4,500. Okay. So it started with 6,000, we used up 4,500, so now its balance will be the 1,500. That'll match what they told us. So that's a prepaid expense one. Let's see, after that, we have fees earned but unbilled, 10,200. Well, what type of adjusting entry is that? Fees earned but unbilled. Is it an accrual or a deferral?
To be a revenue, so it'd be accounts receivable and revenue.
Right, very good. Yeah, it's an accrued revenue. So yeah, we're going to debit accounts receivable and credit revenue because we're just billing them. If the fees were earned, but we just haven't billed them, well, we need to bill them. So that'll be a debit to accounts receivable and a credit to fees earned for that 10,200. Okay. So it's just unbilled revenue. So we need to bill it. The next one, they tell us supplies on hand are $615. Well, again, that's one, it's a prepaid account, prepaid expense. And so we need to look at what we have in supplies before this. So before any adjusting entries in supplies, I had $1,725. And they're telling me I have $615 left. So how much was used? $615. Perfect. Okay, so we had 17. What was it? I forgot already. 1725. And now we only have 615. So we subtract to figure out that we used up 1,110 in supplies. So that's an expense. So supplies expense gets debited, 1,110, and supplies gets credited, 1,110. Okay. And then last but not least, it says rent unearned at July 31st is 300. Yeah, this one's actually a deferred revenue. So since it's an unearned rent, instead of being a prepaid, it's actually an unearned, so it's a deferred revenue. So that does get a little tricky because we have prepaid rent and then we have unearned rent. So anytime you see the word unearned, that is going to be a deferred revenue. So yeah, rent unearned as of July 31st is 300. Well, we have an unearned rent, which is a liability, and it's 3,600. So that's where we started, or how much we had in unearned rent for the whole year. Well, now only 300 of it is unearned. So how much of it have we earned? Yeah, 3,300. We just subtract. And so now we need to show, well, 3,300 was earned. So we debit the unearned rent and credit rent revenue for the 3,300 that we've now earned. Okay. So that's kind of a good example, similar to what you see on the project and on your chapter 3 homework, of adjusting entries at the end of a period. So we had a couple of depreciation ones, we had a couple of prepaid expenses, and then I think we had one of each of the other, like one accrued revenue, one accrued expense, and one deferred expense. So those are all the different types, okay, that you're going to see. So after we've done that though, what happens is now our accounts have changed, right? Like our balances, not all, but a lot of our account balances have changed. So after we do these adjusting entries, we need to prepare what we call an adjusted trial balance with the updated account numbers. So we didn't do the ledger in this question to save time, but normally, you know, we've journalized all these adjusting entries. We would then post those to the ledger and update our account balances. So we would have new account balances for any account that's been adjusted. And you'd post them the same way you would post any journal entry. The only difference is in the item column, you're going to actually put the word adjusting in your ledger. That's the only difference. But otherwise, you're still going to show, you know, the debit or credit and put the new balance, just like you would any journal entry. So what we have to do here, since we don't have a ledger, is we just have to kind of look at it and adjust them ourselves. So it says determine the balance of accounts affected by the adjusting entries and prepare an adjusted trial balance. Okay, so we're really just going back through and doing a new trial balance. So, you know, we're going to start with cash, just like our old one did. Have we adjusted cash at all? No. And that's one thing you'll notice over time. We never adjust cash. So cash is still a debit balance of $10,200. Okay, so cash is going to stay at $10,200. Then I would look at accounts receivable. Did we do any adjusting entries on accounts receivable? Yes, we did. We had one, right? We had this one here, accounts receivable, $10,200 debit. So what I would do is I would look at, before adjustments, my accounts receivable was $34,750 debit. Okay. Well, now I'm debiting it an additional $10,200. So I just need to take those and add them together. Very good. Yeah, my new accounts receivable balance is now $44,950. So I took the existing debit and added the one debit I had. Okay. And then I just go on down the list. So next I have prepaid insurance. Well, I know I did something to it. Here, I credited prepaid insurance $4,500. Okay. So prepaid insurance started with a $6,000 balance, debit balance, and I credited $4,500. So there I have to subtract, right, to get the new balance. It had a debit, we credited it $4,500. So your new prepaid insurance balance should be $1,500. Perfect. Okay. And that matches what they told us in the adjusting entries, that that was the new balance. And then I have supplies. Did we adjust supplies? We sure did. So, and we credited it, right? $1,110. And its starting balance was $1,725. And we credited it $1,110. So how much do we still have in supplies? $615. Perfect. Very good. And that's what they told us, right? That we should have. So we did good there. Did we adjust land at all? No. So instead of flipping back and forth, land is $50,000. So land started as a debit of $50,000 and it stays there. Did the asset building itself get adjusted at all?
No.
No, because the asset building stays on the books at its original cost. So it's $155,750. $155,750. So that's the building. But then next we have accumulated depreciation on the building. Now, did we adjust it? Yes, we sure did. So it started with, let me find it here. It started with 62,850. And then on the building, we credited it another 6,400. So it had an existing credit balance of 62,850. And then we credited it an additional 6,400. So what's accumulated depreciation for the building? What's its new balance? It'd be a credit, and then we credit it again.
$69,250.
Yep, you got it. Yeah, so 69,250. So we just added them together since they were both credits. And then we had equipment. And again, equipment is an asset. It stays on the books at its original cost. So it was 45,000. 45,000. But then we know its accumulated depreciation on the equipment also changed. So it started as 17,650. 17,650. And that was a credit, and then we credited it another 2,800. So it would be 20,450. So an existing credit of 17,650, and then we credited another 2,800. So it's gone up to 2,450. Accounts payable, have we done anything to it? Did we adjust it at all?
No.
No. So it's just going to be its 3750 that it was. So accounts payable did not get an adjustment. How about unearned rent? Yes, it sure did. So originally we had a credit of 3,600, and then we debited it 3,300. So what's its new credit balance? 300. Good. We'll subtract. Oh, we're going dark again. Need to move around more, I guess, right? It really thinks we're not in here. Okay. Unearned rent 300. Now we're still in liabilities. Well, we have a new liability, salary and wages payable, that we used in the adjusting process, and we credited it how much? Let's see, 900. Good. So that has a 900 credit balance. It didn't have an existing balance, so now we have a new account there.
How? Because that's on, oh, just kidding. Because we did payable, not expense.
Yes.
Yeah. Right. Just kidding.
Oh, you're good. Let's see, we have common stock next. Common stock, does it get adjusted? No, common stock will never be adjusted. So it's at 60,000 balance, 60,000. And that's the same for the next one, the retained earnings. Retained earnings doesn't get adjusted. So retained earnings is going to be the 93,550 that it already was. 93,550. And same with dividends as well. Dividends does not get any type of adjustment. So it had a debit of 8,000. A debit of 8,000. What about fees earned? Did we do anything to fees earned?
Yes.
We did, good. And
10,000.
very good. So it increased 10,200. Its original amount was 158,600. So that would make it 168,800 if we add the 10,200 on it. So that one we did credit 10,200, so it increased. And then while we're still in revenue accounts, we have a new revenue account. We have rent revenue that we adjusted on our last adjustment of a credit of $3,300. So that would be recognized with our revenues. So I'd have rent revenue of $3,300. And then we have the fun task of putting all of our expenses in. Expenses they list in order from highest to smallest. So that's kind of where the order is going. I always tell students the other way of figuring it out is just look for the expense in the drop down because I'll only give you one at a time. So, you know, salaries and wages expense comes first. These will all be debits. We did have an existing salary and wages expense of $56,850. And then we know we debited it an additional $900. So that balance will actually change. So it started with a debit of $56,850 and we debited it $900. So $57,750 is the new debit balance. And we did not adjust utilities expense, which is the next one that they give us. So utilities expense just stays at the $14,100. So utilities is still $14,100. Same with advertising. Advertising expense did not get adjusted, so it's still $7,500. $7,500. And then if you look on your unadjusted trial balance, there's no depreciation expense on there yet. So the next one we list is depreciation expense on the building. Depreciation expense on the building. And it's just the expense for this year, the $6,400. Okay, so that's just the debit that we did this year. And we'll learn more about that next chapter, why that's a new, fresh yearly number. The next one is repairs expense. There were no adjustments on repairs, so it's $6,100. $6,100. See, we did not have an insurance expense on the unadjusted, so that one's also a new one, insurance expense. And we had debited insurance expense in our adjusting entries for $4,500. So that's the amount that I would put there, $4,500. We're almost finished. I know it's long when you're doing all this, right? The next one is depreciation expense on the equipment, which was a debit of $2,800 for this year. And then the next option is supplies expense, which again was not on our unadjusted. So it'll just be the $1,110 that we debited in the adjustments. And then miscellaneous expense is always listed last. That's why even though it's higher, it's at the bottom. So miscellaneous is $4,025, and it's always listed as the last expense. Okay. And to save you time, I have added all of these up. And the total debits are $420,300. So $420,300, and that's the same for your credits as well. So if you typed everything in correctly, you should get $420,300 and they balance. So again, after we journalize and post adjusting entries, we always do what we call an adjusted trial balance. Because now we have all the account information we need, we can take this and prepare financial statements, which we'll do again in chapter 4. We'll learn about closing process and preparing financial statements. Which again, we've already done basic financial statements, so that's nothing new. It's just reviewing it and kind of seeing the whole process now that we've gone through after chapter 4, we'll have completed the entire accounting cycle from start to finish. So it's just kind of bringing it all home. So any questions on adjusting entries or the adjusted trial balance? or anything we talked about in chapter 3? Okay. Well, I think as long, and I know they have the same kind of stuff I have on the board in the PowerPoint, like they have 2 slides that kind of go over the different adjusting entries that are really helpful. As long as you have that in your notes, you know, and you can identify which one, and then you're really just calculating amounts, and it's not too bad. So, okay. And we are finished. Woohoo.